In today's video, let's talk about a company called Shift4 Payments. Shift4 is a payment processing company that operates primarily in restaurants, hotels, stadiums, and the like. A little over a month ago, I opened a position in Shift4. Nothing major, it was like a 5% position. But over the past 1 month, the stock has rallied over 35%. So I'm kind of left with the dilemma like, do I dollar cost average up now? Do I leave the position alone? Do I even sell it off? In this video, what I'd like to do is kind of go over the research, go over my findings, and ideally impart wisdom if there is any to be had. My name is Scott. If you're new to the channel, welcome. Hit that subscribe and notification bell. And if you're not new to the channel, welcome back. Let's talk Shift4. All right, so what we're going to do in this video is we're going to go over the valuation model that I built for Shift4. So the general structure of this, if you're not new to the channel, we go through the income statement, the balance sheet, the cash flow statement, and all of these cells from above, they get fed down below, and ultimately we find an average of those, and we use a formula to basically feed the information back up and populate the forward values. So essentially this whole thing is kind of like a large formula that works together. We're also going to cross-reference what I have here with what the analysts are expecting for next year. And by the end of the video, what we're trying to anticipate is what the fair value of Shift4's share price is or should be. So we're going to go through all of this in more or less chronological order. The way that I have things structured here is I like to start up top with the acquisitions. The acquisitions is always one of the first things that I look at when anticipating the forward growth of a company. A company could be growing at a fantastic rate, but if they're having to basically buy that rate in the form of acquiring other companies, that's something that is commonly referred to as non-organic growth. So if a company, for example, has to pay millions of dollars in order to get 20% growth, it's disingenuous, for the lack of a better term. And not to say that Shift4 is doing anything wrong here. I think there's going to be great synergies with the past acquisitions, Finaro especially, Finaro being one of their larger acquisitions over the past few years. So that's something that we'll keep in mind throughout the video, is that Shift4 they have been growing at a very fast clip, and they seem to be continuing that on into the future. But it's always good to keep in the back of your mind how much of that growth is genuine or organic. Another thing to mention before we start going down the list here is the model that I built. This isn't as extravagant as some of the other ones, Enphase Energy, Rocket Lab. Tesla's not public yet, but those ones go quite a bit further back and quite a bit farther forward. I find it personally a lot easier to find the valuation of a manufacturing company. The reason for that is because you can have an idea of what the company is building, how many units they're able to build, the ramp rates or the production rates, and therefore it's a lot easier to extrapolate those numbers forward and ultimately arrive at revenue, cost of revenue, gross margins, and kind of go down the line that way. However, with a payment processing company, it's a little more difficult for me to determine. A large part of that too is because it's so heavily dependent on the economy, right? Because essentially the way that Shift4 makes their money is a small percentage of every dollar that's made in every hotel, every stadium, every restaurant. So if there was some sort of we'll call it economic unrest, Shift4 would definitely not be my top pick as far as a stability play, right? If everybody suddenly stops spending money, I mean, if we have another outbreak of the C word, that the word I'm not allowed to say on YouTube, that could be detrimental for a company that heavily relies on restaurants, for example, on hotels, on stadiums, on these large public gatherings, right? So essentially, when you're trying to determine the forward value of a company like a payment processing company, it's a little trickier because you're essentially trying to determine what the overall economy is going to be doing over the next 5 to 10 years. So as a result, basically what I'm trying to do is just find the value of Shift4 today. I'm not trying to find technically I guess we do go out to the end of 2024, but it just doesn't go as far into the future as some of the other models. On that note too, we didn't go as far back, and the reason for that is because there were a few amendments that were made in 2022, and as a result, some of the past numbers were filed differently. it's not a red flag. It's not like the numbers were wildly inaccurate, but like for example, I can't remember which category it was exactly, but I believe it was. Um, this isn't going to be perfectly accurate, but you'll understand what I'm saying. Is like professional fees might have been an extra, you know, an extra $1,000 higher, but DNA expense might have been $1,000 lower. So it's just a couple little mismatches in how things were supposed to have been filed. Ultimately, what we're doing is we're just looking at the past 7 quarters that were filed and using that to determine the next 5 quarters that will be filed. So with that out of the way, what we'll do is we'll start at the top line, obviously, the revenue, and we'll work our way down. I guess before we get into my figures, we'll cross-reference that with what the experts are saying on Yahoo Finance and on Morningstar. So I guess we'll start in statistics here for Shift4. Trailing PE is 40, and the forward PE is 17. So a little over a month ago, I think the forward PE was like, I think it was between the 12 and 15 mark. It was largely part of the reason that I opened that position is just looking at the past growth and comparing it with the forward growth. You'll see what I mean by the end of the video, but it almost seemed like a bit of a no-brainer to go through with opening that position. So even after this run up, a forward PE of 17 in my approximation seems low. So next we'll hop into analysis. So what we'll do here is we'll look at the number of analysts at any given time, basically 13. I mean, we see 16 here for next year for the earnings estimate, but the revenue estimate is 13 here. So it's not just 1 or 2 analysts that we're getting this reference point from. I'm not going to bother reading everything off. Just know that, I mean, take a screenshot if you need to, but all of these reference points, these have been already transferred over into the spreadsheet itself. So we can see here that the revenue estimate is going up by a meaningful amount. Keep in mind there is that Finaro acquisition in there, tucked in there as well. What else do we have here? EPS trend, EPS revisions, growth estimates. For the current quarter, 83%. Next quarter, 53%. For the current year, 106%. Next year, 40%. And the next 5 years is, we'll call that 50%. So it's a company that is growing at a very fast clip, acquisitions or not. Finally, we'll look at the estimates of the price target estimates. The average estimate is $78, we'll call that. The current is around the $65 mark. I think that's all we'll look at for Yahoo Finance. We'll hop over to Morningstar. So fair value for Morningstar, just over $82 as well. Yeah, okay, so we're going to kind of leave it there. Price to earnings is 40. Do they have a forward price to earnings? Not that I see. Cool. All right, let's hop back to the spreadsheet. Okay, so for gross revenue, I think I realize that this part it may be dry for a lot of folks. Some others. I mean, you probably love this stuff like I do. Cool. I'm just gonna try to kind of push through this. I don't want to labor the point. I'll kind of highlight any points that really need to be accentuated, but a lot of this is very like formulaic. So if you understand how I'm arriving at one number, a lot of that just translates all the way throughout. So I'll try not to drone on too long, but I will be thorough where I need to be. Okay, so what we'll do is we can see the most recent quarter that was reported, and then we can see the next quarter that we're expecting, as well as the next full year, 2024. So for gross revenue, you can see what the guidance for the full year has increased to. So this is the guidance from Q2. This is the most recent guidance from Q3. And then we have Yahoo Finance, basically 758 million, we'll call that. Hold on. Sorry, that's for Q4. And then for the full year is the 2.62 billion. So what we're going to do is we'll quickly highlight this. Hopefully you can see it in the bottom corner here. Oh no, shoot. Okay, no problem. In the bottom corner, it shows me the sum. I can see that the sum of what's highlighted here, this is 2.6 billion. So this line, the 2.6 billion, that lines up with exactly what Yahoo Finance and with the Q3 guidance. Next up, we have 7.81 million from Yahoo Finance again. I'm a little low on this number, but I'm doing year-over-year comparison, and worst case, if I am a little bit lower, I'm comfortable with that. I'd rather be on the low side than on the high side, and then feel like I'm being too optimistic. So I think for the full year, though, everything kind of comes together. Yahoo Finance has $3.73 billion for the full year, and what do I have here? Highlight them all. I'm at 3.6 billion. So what did they say? 3.7. Again, I'm a little low here, but as you can see, like the multiplier, this is the year-over-year multiplier. So essentially, what this number is doing, it's taking the value from 1 year ago, and it's increasing by this number over here. So what we have Shift4 growing at for the next year is 39.57%, and that ultimately lands us a little bit bearish compared to what the average analyst's estimate is going to be. Next up is the cost of sales. So any of the rows that you see that have a value in the multiplier column, they're essentially doing the same thing with the growth rate. So the cost of sales in this case, I'll just show you one example. So we'll go down below here. So it takes the cost of goods sold as a percent of revenue. So in other words, what it does is it is going to take the cost of sales and divide it by the gross revenue. And that ultimately lands us at 73.3%. And if we go back, like I said, to 2022, you can see that this number is more or less consistent. We have 78, 79, 75. It's all around that 75% mark. And what we do on the far side is, we see that it's 75 as an average of the past 7 quarters. I'll just show you again quick. The past 7 quarters are the ones that are highlighted, and then that's finding the average. So this number ultimately feeds up to here, and that's how these numbers are arrived at. The forward values are arrived at. So in this case, it takes the revenue and it multiplies it by the average of what we found down below, the 75%, and that's how we calculate the cost of sales. So you're seeing already what I mean by being thorough when we need to be, and then the rest of the data kind of cascades throughout. The darker cells here these are basically just formulas. So these are things that don't need to be adjusted at all. It's finding the gross income, which is simply the revenue minus the cost, right? And then ultimately the margin is just the income divided by the revenue. The next section we don't really need to go over. This is doing the exact same relationship as what we just went over with the cost of sales. So these are all growing at, the percentages that you can see here. And if we rewind a little bit, you can see that the total operating expense going, 136, 133, 135. It's going to jump up a little bit, but keep in mind that's because of that Finaro acquisition. Quick side note, I think I mentioned that the Finaro one's a bit heavier weighted as far as an acquisition. Finaro is, if memory serves, it's a $575 million acquisition, whereas Focus Point of Sale Systems, that's a $45 million acquisition, and Securion Pay, 125.9 million. So Finaro is kind of much heavier weighted, and I guess a side note to that side note, this is when the acquisition was mentioned. I think it was closed within the same quarter, might be off by 1 or 2 quarters, but all in all, like I mentioned up top, keep in the back of your mind, the growth rates are slightly inorganic in some areas. So moving forward, we're up as far as the total operating expense. We can see that we're expecting a little bit of an operating margin hit. This may be a little bit higher, but as always, I'm a little more on the conservative side. Interest income, the underlined cells, these are manual entries. These ones are not based on formulas. A lot of the time that the entries are manually input is, again, for the sake of conservation. Sometimes the numbers come in and they're a little bit higher. So I like to kind of keep it more conservative. So if you, for example, just take this number over and assume it's going to be the same thing, you'll notice that the income before taxes, it actually goes up a little bit. So it's actually a little more conservative to assume that this number is going to be a little bit lower than try to dial it in as some sort of formula. Same thing with some of these other numbers. The other income, for example, I'm just leaving that as blank. It could be a little higher, it could be a little lower, but as with a few other examples, the adjusted EBITDA section, I left that blank as well. The reason for that is that if you were to actually add numbers to that, it's going to become a higher number. So ultimately what I've done here, like I keep saying the word, I apologize, I'm a broken record, but conservation on conservation on conservation. So hopping back up to where we were, it's more or less more of that formulaic stuff. So just taking the past data, finding the average, feeding it back up to the top. We can kind of skip ahead a little bit to net income. Now, there are like 2 kinds of net incomes that Shift4 reports. There's their like general net income, but the one that's important to go with is the attributable net income, because there is a an adjustment made to non-controlling interests. Basically, it means like the net income that Shift4 doesn't keep in-house. So as a result, we can find the net income, the attributable net income, and of course what we're after is the earnings per share. So this is the next section where we can compare with what the analyst estimates are, and probably no surprise by now, my numbers come in a little bit lower than the analyst expectation average. So for here, we have Yahoo Finance is actually more than double of what I'm expecting here, and I'm honestly a little bit not sure how theirs are so high. Even when I first saw that they were at 0.86, I was wondering if maybe they were not going with the attributable net income. I'm still a little bit unsure, but I'm comfortable being wrong on the downside. And then the full year is going to be 2.86. We'll see what I have here. If you bring these over, I'm at 1.65. So maybe I'm completely missing the mark on this quarter. It's largely dependent on Finaro, I suppose. But again, that's the inorganic growth that I keep mentioning. So next up, we have the shares. Basically, the share count, the public share count, the total share count that you or I would be looking at is the total of A plus C. The Class B shares, that's basically for like founders, management, executives, etc. And then the shares that you or I would be buying is Class A. And then Class C, if I'm not mistaken, maybe I even have it written down, but I think Class C is for, I think it's for like, sometimes the acquisitions that are made aren't just in cash, sometimes they're in stock bonuses as well. I think Class C would be an example of when those types of shares would be given out. 1 vote per share for Class A, 10 votes per share for Class B, and 10 votes per share for Class C. So yeah, basically like you or I would be getting the Class A shares. Class B and C are kind of like super weighted, so to speak. So finally, we can arrive at the formula for EBITDA. I think they only guide for adjusted EBITDA, which, it's not my favorite thing. It's much preferable for a company to just say like what their earnings are going to be. It's just like EBITDA is already the adjustment, then you're making an adjustment to the adjustment. At that point, it's not my favorite way to value a company is looking at the adjusted EBITDA or adjusted free cash flow, which we're going to do as well here. But it is what it is. It's all dependent upon the maturity stage of the company, right? Oh, I'm realizing too that I didn't do the EPS for the full year. We'll hop back to that in a second here. So for the most recent guidance that we have for adjusted EBITDA, that's we'll call that 460 million here. If we take the highlight, we're a little low again, no surprise. We're at 430.1 million. Keep in mind too, like by the time we arrive at the share price at the end of this video, that's all based on these numbers that are low on my end. So if the share price seems to make sense, again, it's not financial advice or anything, but if the share price makes sense with these valuation models, it's probably in the direction of making sense as far as being a shareholder. That's my opinion. That's for me. I'm not saying it's I'm not advising that for anybody else is what I'm saying. So hopping back up to the EPS, over here I wrote down like basically this is taking the sum of this and of this. So this is the full year for general, and this is the full year for attributable. Yahoo Finance is at 3.97, so they're like double what I have. So I'm like cool, cool. If I'm that far off the mark, awesome. So over here, these are the multipliers for the shares that we see. If we zoom back a little bit to 2021, you'll notice that the Class C shares are going down. You'll notice that Class B shares are also going down. It's always a good sign, if they're heading in the other direction, you're being diluted as a shareholder, and nobody likes that feeling. Now, the Class A shares are going up, and they're going up quite a bit in this quarter, as you can see here. In Q4, the company will issue approximately 7.4 million shares of Class A stock in connection with the acquisition of Finaro. So that number is going to go up by quite a bit. I don't love it, but it is what it is. And it's a one-time adjustment for what is going to be a running start to the European expansion. So moving on through the next section, I think I already mentioned this stuff about adjusted EBITDA. Leaving this blank is actually more conservative. For example, if we do just drag these values over and assume that it is going to be 5 million and 12.5 million, you're going to notice the adjusted EBITDA goes way up. So by leaving it blank, it is more conservative. The next section below, this is where I'm starting to swim outside of my depth. I find that it's a lot easier to find the net income of a company. The cash flow statement is a little less easy to make as a formula. What I mean by that is you'll notice that there isn't as much consistency in the numbers. I mean, there is for depreciation and amortization. I mean, to an extent, of course, you get, from 29 to 42, 47, 47, 50, 55. A little less consistency there. This number should probably be raised, if anything, but we are going to leave it. Essentially what we do for this entire section, due to the lack of consistency in the numbers within the cash flow statement section, is we're simply just taking the previous 3 quarters and assuming that the next quarter, that the upcoming quarter, quarter 4, is going to be the average of those 3. And we're also going to use the same numbers extrapolated forward. Now, that's not the accurate way to do it. I realize that. Someone with a little more insight than myself could fill this in with a little more detail. That's fine. The cash flow stuff is still going to be probably under the mark compared to what it's actually going to land on. What else do we have here? So those are hard-coded. These are averages again. So same thing for the net cash used in investing activities section. These are all going to be just averages and extrapolated forward. And then same thing again, using the past 3-quarter average, extrapolating that forward, lands us at the adjusted free cash flow, which isn't even used for the formulas that we're going to use to arrive at the share price. So we can kind of more or less just skip past that. The free cash flow and the adjusted free cash flow are almost certainly going to be higher, but we're just leaving them as is for the time being. All right, and last but not least, we're going to find out the share price. Before we do that, if you're getting value from this video, please leave a thumbs up. It really helps with the channel, and it's much appreciated. I put a lot of work into this, and I hope that I'm providing value. So let's get into the share price. So we are going to scroll back a little bit. Don't want to spoil it too much, but we are going to scroll down a bit. So these you can see as far back as 2022. You can see what the share price has been. The PEG share price, essentially what that uses is it's more based on earnings. The margin of safety price, that's based on revenue, equity, operating cash, and net income. And the payback price is the free cash flow. Now, if I had to categorize Shift4 into one of these, like what I mean by that is, if one of these share price formulas is more important than the other, it's going to be the payback price. It's going to be the one that's more dependent on free cash flow. But you'll notice that if we do so, the share price gets high just due to the nature of what the growth is doing. I'm also realizing we should probably go over this really quick. In this section of where everything is calculated, we're also calculating the revenue growth, the net income growth, as well as the attributable net income growth, and then the free cash flow growth. So what we're expecting from the forward revenue growth is based on the previous 7 quarters of revenue growth, if that makes sense. And as you saw earlier, using this growth rate, this lands us just a tad bit conservative compared to what the analysts are expecting. So we're going to keep that. We're locking that in at 39.57%. For the net income, the attributable net income, and the free cash flow growth, what we're going to be doing, instead of doing the past 7 quarters of growth like we did with revenue, we're going to look at the upcoming 4 quarters of growth and what we're expecting. Now keep in mind, all of these growth rates are very low compared to what the street is anticipating. So if we were to take the next 4 quarters and compare them to the year before of each of the 4 quarters, hopefully that made sense, we're going to land at 38.46% for growth. Now you'll notice there's a big dip in the Q3. It's just the way that the numbers worked. If you want to take a look at that, where are we at? So 33 coming from, 32. So again, these are almost certainly going to be higher, but if I'm wrong, I'm wrong in a beneficial direction. So for the attributable net income, this is the value that is going to be integrated with the formula is this 38%, because that's the expected forward growth. And then we have the similar situation, upcoming 4 quarters of growth for free cash flow. That lands us at a clean 17%. This is the one that's going to be integrated with the payback price. This is the current share price, what it closed at today. I'm filming this on December 6th, so I guess it'd be yesterday by the time you see this video. The current, fair price, so to speak. And again, these numbers are depreciated from what I think will actually come out. But we have $62 for the PEG share price, $50 even for the margin of safety price, and $65 for the payback price. So it's kind of at fair value, so to speak. And if we were to scroll ahead a few quarters and kind of look at the multiplier section, we can see that these numbers here, these can kind of be manipulated, because if the overall company is growing the revenue at 40% and the attributable net income is also growing right around that 40% mark, it's safe to say, well, it should be safe to say that the company is going to be growing free cash flow at a higher rate than 17%. But, just for the sake of entertainment, let's play on with these numbers a little bit and arrive at what could be a bull case, so to speak. So we're going to leave the earnings alone because, like I said, I feel more confident in finding the net income than I am finding the free cash flow. So we are going to leave that at 38%. Also pairing that with feeling comfortable with what we arrived at for the revenue growth rate. So if we were to take the margin of safety price, and like I said, if they're growing net income and revenue and everything else at 40%, it's safe to say that they basically overall business, what the margin of safety is ultimately trying to predict, is going to be growing at a faster rate than 20%. So let's see what happens if we adjust this to 25%. You're looking at a share price that should quote unquote should be $95. So again, it jumps up quite a bit. Especially with the margin of safety price, and if we were to get crazy with it, if we are growing at 30%, $167 is fair value. I'm not saying that's what it's going to be. I'm just saying that's what the formula is saying. So we're gonna rewind that a little bit. We're gonna come with something a little more rational for the time being, 22.5%. That still lands us at, we'll call it $70. Next up is the payback price, because like I've said, it seems to be at fair value with the assumptions that we currently have, but the free cash flow is almost certainly going to be growing at a faster rate than 17%. So I think it's safe to say 25% for the foreseeable future. And if we put that in, let's see what the share prices land at. So not $93. So I mean, that's still like a 50% upside to what is current. There seems to be a decent amount of growth in share price appreciation for Shift4 in the future. I'm not saying it's all going to happen overnight. The market is efficient over time, but very inefficient in the short term. Absolute bull case is this is closely, even more closer mimicked with the net income, go 30%, $120 share price, $140 by the end of next year. And so if we change this back up to 25% and look at the overall share price, by the end of next year, I'll say we could be trading around the $115 mark. Now, this is assuming that everything goes well over the next year. This is assuming that as we're coming out of 2024, that we are still having a forward growth rate of anywhere within the 30% per year mark. So if we do end next year and Shift4 does still seem to be growing, and I mean, they almost certainly will be, in my approximation, it seems like, their global expansion is basically just beginning. They're a company that's more than 20 years old, and it's not until the past 2 years that they've been starting an international expansion. So it seems to me that there is a lot of growth in the years ahead for Shift4. And after putting all this together, I'm not going to lie, I'm a little more bullish than I was even a month ago. I knew that there was upside to Shift4, but it seems like it's one of those situations where you wish you added more. But it's better than wishing you'd added less, I suppose. So there's that too. But all this to say is, if you guys are interested in taking a look at the spreadsheet yourself and manipulating the numbers, this will be available on the Patreon, as well as Rocket Lab, Enphase Energy, Planet Labs, Tesla one day once I finally finish it. And right now, until the end of the year, there's early bird pricing. I'm not sure exactly how much it's going to be raised quite yet, but I mean, the sheets are cheap as fuck. Considering the amount of work that I put in, considering the amount of value that comes out, I'm not charging enough if I'm being blunt. So, highly encourage you to jump on the early bird pricing. And like I said, if you guys enjoyed this video, if you got value from it, leave a like, leave a comment. I'd love to hear from you. Am I off the mark with this? What other companies would you like to see me go over? Thank you guys for the hangout. I appreciate your time, and I'll see you in the next one. Cheers.